Hi everyone, welcome back. In this session, we're going to discuss the relationship between the price of a bond and the yield. Now, when I utter the word price, what I actually mean is I'm assuming equilibrium in a situation where both price and intrinsic value are actually equal. That is, there is no market mispricing. When price and intrinsic value are equal, we are said to say that the market is in an equilibrium state. All right. So the words price and intrinsic value are going to be interchangeably used. So when I utter the word price, do not assume it to be the market price, but take or rather assume that the market price is actually equal to the intrinsic value. All right. So when I say that we're going to study the relationship between bond price and yield, what I'm indirectly trying to say is we're going to study the relationship between the intrinsic value and yield. Now, when I talk about yield, what I'm actually referring to is the discount rate that we were using at the time of finding the intrinsic value. The discount rate that we were using is nothing but YTM, and that is what I am referring to here as yield. Okay, so we are going to study the relationship between price and yield, which means what we are actually going to do is we are going to keep changing yields and going to see the impact that that change in yield will have on the price. Okay, so we will keep changing yields and we will see the impact that the change in yield has on the price. All right. Now, if you quickly recall the definition of or the method of calculating the intrinsic value of a bond, the intrinsic value is the present value of all the future cash flows discounted at the required rate of return. Required rate of return is nothing but the yield to maturity on similar bonds. Okay. So if I just quickly come to the Excel file, we did a calculation initially where we actually took a $50 coupon, 1,000 face value, a required rate of return or investors required yield of 4%, and we calculated, and the term of the bond was 3 years, and we calculated the intrinsic value to be 1,027.7 or 1,028. All right. So if you actually look at this, there are 4 inputs that are going into calculating intrinsic value. One is the term, which is the number of periods for which I'm going to receive coupon. 2 is the amount of cash flows, which includes the amount of cash flow in the form of coupon and the amount of redemption value. So there are actually 2 inputs over here. One is the amount of coupon and the other is the amount of redemption value. And 4th input is the discount factor. Okay, so the 4 inputs are 1, term; 2, the cash flow in the form of coupon; 3, the cash flow in the form of redemption value; and 4th is the discount rate that we are using, which is nothing but the investor's required rate of return or YTM. Okay, now what we are going to do is to find out the relationship between bond price and yield. I will keep 3 out of 4 of these inputs constant, and I will keep changing one of them. And that one thing that I will keep changing is nothing but yield. Okay, what I would do is I would keep the term the same. I would keep the coupon the same. I would keep the redemption value the same. The only thing is I will keep changing yields at multiple times. I will keep changing yields multiple times. All right. But of course, I'm taking a fresh example intentionally. I'm not carrying on with the same example. I'm taking a new example. So I'm considering an example where we have redemption value of $1,000, the coupon rate of 4%, remaining time to maturity. I've taken the remaining time as 50 years. And to start with, I've taken investors' required yield of 3%. Okay. Now let us first actually calculate the intrinsic value given these facts. Okay. So now this is a fresh example. It has got nothing to do with what I was just showing earlier. Okay. It's a completely fresh example. Let's start from here. So the first thing that I'm asking you to do is calculating the intrinsic value of this particular bond given all these 4 inputs. Remember, I told you we need 4 inputs. All the 4 inputs are actually included in this in these 4 sections. All right. So if I'm coming back to the Excel file, I've basically created 2 columns. One is for yield and intrinsic value. Of course, you can find the intrinsic value using the table method that I have done over here. But obviously now, given that I have 50 years of time to maturity, I'm not going to do 1, 2, 3, 4, 5, 6 until 50. What I will actually do is I will use the Excel method of calculating the intrinsic value. So what I'm now doing is on this particular row, I've intentionally marked this row for a particular reason. So on this particular row, I'm writing the investor's required yield of 3%. Okay, the investor's current required yield is 3%, and I'm now calculating the intrinsic value at this particular yield or at 3% yield. Okay, the Excel formula is equal to PV. You have the first input that you are required to give is the rate, which is nothing but the 3% investor's required rate of return. The second input is NPER, which is number of periods. I hope you're able to actually see this. It's the rate is 3%. NPER is number of periods. Number of periods is nothing but the remaining maturity of the bond, which in our case, I've assumed it to be 50 years. The third input that is required is PMT, which is nothing but the payment per period. The payment per period in our case is the coupon rate of 4%, which translates into $40 or 40 rupees, because we have a face value of 1,000 and we have a coupon rate of 4%, and therefore we have $40 as the coupon amount in dollar terms. And the next input is FV. In one of the videos earlier, I actually mentioned FV as face value. I'm taking this opportunity to actually correct myself. FV is actually the future value and not the face value. Okay. In that case, in our case, the future value was the face value, but technically what you actually have to write over here is the redemption value. Okay. The future value is nothing but the redemption value, which in our case is also equal to the face value. So I'm pressing 1,000, which is nothing but a redemption value. And then it has something called as type. Under type, you have to select either 0 or 1. Okay, 0 refers to end of the period and 1 refers to beginning of the period. The end of the period basically refers to, if I select 0, what I'm trying to say is all the cash flows are going to be received at the end of each period. Okay, which means I receive cash flows at the end of year 1, 2, 3, and so on. If I select 1, what I'm trying to say is I receive cash flows at the beginning of each period, which means I receive it at the beginning of year 1, beginning of year 2, beginning of year 3, and so on. Obviously, in our case, where we are dealing with bonds, we receive coupon and face value at the end of each year, right? So obviously, I'm required to select 0. Whereas in case you're solving an insurance kind of a problem where you have premiums which are paid upfront, premiums are generally paid at the beginning of each year, right? In such cases, you're supposed to select 1. Okay, but over here for us in the subject matter, what we are required to select is 0, obviously. Okay. So I've calculated the intrinsic value, and this intrinsic value is also the price of the bond, right? Because I've assumed that the market is in a state of equilibrium where price is equal to intrinsic value. Okay, so we have a required rate of return of 3%. This was the heading. Let me otherwise actually freeze it. Give me a second. Yeah. Okay, so I have taken a yield of 3%, and I have calculated the intrinsic value or the price to be equal to 1,257. Okay, now the meaning of this is, if I as an investor, I want a rate of return of 3%, if I want a return of 3% and I have a bond in front of me, which is paying $40 in the form of coupon for 50 years, and which is going to pay back a redemption value of $1,000 at the end of 50th year, then the maximum price that I'm supposed to pay is 1,257. I am supposed to pay 1,257. Okay, this is the maximum price I'm supposed to pay if I want to earn a return of 3%. Okay, now to understand the relationship between price and yield, what I'm actually going to do is I will keep increasing, and I would rather first decrease this yield by 0.25%, and I will calculate the effect that it has on price. Okay, I'm going to decrease the yield by 0.25% and then see what is the price going to be. Okay, so out of the 4 inputs that we discussed, I am changing one input, which is nothing but the investor's required rate of return or YTM on the bond. Okay, so what I'm doing is I am reducing the yield by 0.25%. And now I would like to recalculate the price or the intrinsic value at if the investor's required rate of return is 2.75%. Okay, what I'm actually doing is I'm applying the same formula again, equal to PV. Now this time it's asking me for the rate. I'm linking the rate to cell B14, which is 2.75%. The number of periods is the same, which is 50. The PMT, which is payment per period, is also the same, which is 40. And the face value is also the same of 1,000, and then the type is obviously 0 again. Okay, now if the investor's required rate of return is 2.75%, the bond price is 1,337. Okay, the meaning or interpretation of 1,337 is if I want a rate of return of 2.75% from a bond, which is paying a coupon of $40, whose time to maturity is 50 years, and which is going to pay a redemption value equal to 1,000, then the price I'm supposed to pay for this bond is 1,337. Okay, so basically, if the required rate of return is 2.75%, for that particular bond, I'm supposed to pay 1,337. Okay, if the required rate of return, if I want a return of 3%, I am supposed to pay 1,257. All right, this is the interpretation. Now, just like how I reduce it from 3 to 2.75, I'm going to further reduce it by 0.25%, from 2.75 to 2.5, 2.5 to 2.25, 2.25 to 2%, and so on. I'm going to keep decreasing it by 0.25%, and I will actually see what is the impact that it has on price. Or basically, I will be recalculating the price at different levels of yield to then study a relationship between price and yield. Okay, so just like how I have reduced the yield from 2.3 to 2.75, I'm going to keep decreasing it by 0.25%. And that is the reason I actually left some space above. All right. But before doing that, for the sake of convenience, I would actually like to just make these negative values positive. Okay, these negative values, remember, these negative values actually denoted that you have to actually have a cash outflow today. Okay, you need to have a cash outflow today to receive cash inflows at the end of each year for next 50 years. Okay, but for the sake of convenience, I'm actually just inserting a negative symbol at the beginning, so that it's easier for me to actually speak through. These numbers are also price, but I'm just denoting it in positive numbers. Okay, now what I'm doing is I'm just going to copy this formula and paste it. So what I've done is I've kept decreasing yields by 0.25%, from 2.25 to 2 to 1.75 to 1.5 and so on. And I've calculated price at different levels. Okay, now if you actually notice, the only thing that is changing in the formula is the yield. Okay, everything else in all these formula is the same. The only thing that is changing is yield. Okay, so what I've done is I've kept 3 out of 4 inputs constant. The only input I've kept changing is the yield. Okay, now just like how I've decreased the yield by 0.25%, I would also like to increase the yield by 0.25% and recalculate the price. Okay, I would like to increase the yield by 0.25% and calculate the price at each of those respective yields. Okay, so I'm doing the same thing that I've done on upside. Sorry, I've forgotten to add the 0.25% symbol. Okay, so the meaning of this is at 3.25%, the intrinsic value is 1,184, which means the price that I'm supposed to pay for this bond, if my required rate of return is 3.25%, is 1,184. Okay, in the same way, I'm just dragging even on the upside, that is, let's go up to 7%, or maybe let's actually go up to 10%. On the upside, we don't have any limitation. Okay, so what I've done is I've kept increasing the yield from 3%. Remember, we started over here. I kept increasing the yield from 3%, and I've gone as high to 10%. All right. So what I've done right now is I have calculated the price of the bond, the price that this bond will have at different levels of yield. Before we actually start any kind of interpretation or drawing any conclusions from this, let us actually plot this in a graph. Okay. Or firstly, let's come back to the PPT. The first question is calculate the prices at different yields ranging from 0% to 10%, which we have actually done. Okay. If we started off with the current yield of 3%, we started off with the current required rate of return of 3%, which was at which the bond's intrinsic value was 1257. And then I went on to calculate the range of intrinsic values that this bond will have if the yield keeps changing. Okay, I have kept changing the yield by 0.25%. I've reduced it from 3% to by 0.25%, and I've gone until 0. And on the higher side, I've increased it. I kept increasing it by 0.25%, and I ended up with 10%. I ended it with 10%. I can actually go even beyond 10%, but I actually stopped. Okay, because what I wanted to prove is going to be sufficient with 10. All right. And then I've calculated the intrinsic value that this bond can take at different levels of yield. Okay, so all I did was I just kept changing the yield and I recalculated the price that this bond will take at different levels of yield. Okay, now I am actually plotting this on a graph. Okay, I have plotted this on a graph. Let me move it a little side. Now, if you actually look at the graph, it's a curve. Okay, the bond price graph is actually a curve. Okay, now the way to read it is, let's say I'm picking up this point at 2% on x-axis. So by the way, y-axis has intrinsic value of a bond, x-axis has the yield to maturity. Always when you look at a graph, the first thing that you're supposed to do is see what is plotted on the y-axis and see what is plotted on the x-axis. Okay, y-axis has the intrinsic value and x-axis has the YTM or the yield. Okay, always remember, on the y-axis we plot the dependent variable, and on the x-axis we plot the independent variable. By dependent variable, I meant intrinsic value over here is the dependent variable and YTM is the independent variable. Why are we calling the intrinsic value as the dependent variable? Because the intrinsic value is dependent on yield, right? The intrinsic value is changing with change in yield. Therefore, the intrinsic value is dependent on yield, and therefore the intrinsic value or the price is referred to as the dependent variable and the yield is referred to as the independent variable. All right, yield over here has kept changing randomly. Yield is not dependent on anything, right? So yield in reality is actually dependent on external factors, but over here when we are actually reading the relationship between price and yield, what we are saying is yield is just randomly changing by 0.25%. Okay, so intrinsic value is the dependent variable and the yield is the independent variable. Intrinsic value is being plotted on y-axis and the independent variable, which is yield, is being plotted on the x-axis. Okay, now if you refer to the relationship between price and yield, it is a curve. Okay, so first emphasis is it is not a straight line, it's actually a curve. That curve is a downward sloping curve. Okay, it is not an upward sloping. Remember, in your basic economics you used to have a downward sloping curve and an upward sloping curve for demand, supply, etc. Okay, this is a downward sloping curve. Okay, and it is not a straight line, it is a curve. All right, that is the first thing that I would want you to observe. Okay, 1 second guys, sorry. Yeah, so the second thing that I want to actually tell you is, if you remember, there were two things that you would have learned in your basic school. One is a convex shaped curve and the other is concave shaped curve. Okay, this is a convex curve. Okay, the bond price graph is a convex curve, like the bond price and yield relationship is captured through a convex curve. All right, the word convex is also important. I would like you to remember that because we're going to revisit it at a later point in time. Okay, so three things I've communicated so far is: one, it is not a straight line, but it is a curve. Number two, it is a downward sloping curve. Number three, it is a convex curve as against the concave curve that you might have also learned in your basic school. Okay, now over here, what I would like to actually emphasize is, why is it a downward sloping curve? Okay, why is it a downward sloping curve? If you actually observe, we started with 3%. Okay, or before that, let us actually read any one point on this graph. What we're trying to say is, if the YTM or if the yield is 2%, then the bond price is going to be somewhere over here. It's going to be between 1500 and 2000, but it's going to be actually close to 1500, or it might be something around 1600 or so. All right, now if you see over here, 2% is 1628. That is how it has been plotted. On the y-axis, you can actually, over here, the gap between two units is actually 500. You can actually reduce that gap. You can reduce that gap by formatting the axis. Let me just quickly do it. I'm just making the gap as 200. Let's see, maybe the graph might become a little clumsy, but that's fine. Okay, so if you actually see at 2%, it is touching almost the 1600 point, right? So the price or the intrinsic value of the bond at 2% yield is 1628. Okay, now we actually started off with the yield of 3%, where the intrinsic value is 1257. Okay, I kept decreasing yield by 0.25% and I kept increasing yield by 0.25%. But if you notice something, when I kept decreasing yield, the bond prices kept increasing. The bond price increased from 1257 to 13337. From 13337, it increased to 1425, 1425 to 1522, and so on. Okay, when I kept decreasing the yield, the bond prices increased. And similarly, when I kept increasing the yield, when I increased the yield from 3 to 3.25 to 3.5 and so on, the bond prices actually kept decreasing. Okay, so bond prices and yield have an inverse relationship. They have a negative relationship. When yields increase, the bond prices fall. When yields decrease, the bond prices rise. All right, so the bond yields and intrinsic value firstly have a negative relationship, and this is the reason why you have a downward sloping curve. What it is trying to indicate is, as yield increases, which means as you move further to the right on x-axis, as you keep moving from 2 to 4 to 6 to 8 to 10%, the bond prices actually keep falling. Okay, that is the reason it has a downward sloping curve. All right, so this is the implication. We'll actually see the reason why this is also happening, like why are the bond prices falling when yields are increasing. We will get to the reason later on in the next session, but for right now, what I want you to understand is it has a downward sloping curve because yields and intrinsic value are inversely related. Why they are inversely related, we'll see it in the next session. Okay, that is one point that I actually wanted to convey. Okay, so basically I've communicated about 3 to 4 things in this session. One is the bond price and the bond yields and intrinsic value are inversely related. Okay, it is a curve and not a line. It is the graph is captured through a curve and not a straight line. Number 3, it is a convex curve. It is a convex curve and it is a downward sloping curve because yields and intrinsic value are inversely related. All right. So yields and intrinsic value are inversely related, meaning when yields decrease, intrinsic value actually increases. When yields increase, the intrinsic value actually keeps falling. All right. So maybe that's it for this session. I will actually end the lecture over here. In the next session, we are going to draw a few more conclusions on the basis of this graph over here. All right. Thank you guys. Bye.